Good day, everyone, and welcome to today's session on one of the most important yet complex areas of international trade for multinational enterprises: transfer pricing and customs valuation. Now, we will be looking at Module 14, transfer pricing and custom valuation. We will be diving into how these two critical concepts interact with each other, why they matter, and how businesses can navigate the challenges that arise from their differences. Both transfer pricing and customs valuation deal with the valuation of goods transferred between related parties, but they operate under different legal frameworks, having different goals and involve different regulatory authorities. So we will start by looking at the key objectives of transfer pricing and customs valuation, the differences between them, and why it's important to reconcile both practices to avoid compliance risk. So we will be looking at the overview of interaction between transfer pricing and customs valuation. When we look at the relationship between transfer pricing and customs valuation, we see that both concepts are essential for multinational enterprises that move goods and services across borders. Although they both focus on determining the value of intercompany transactions, the objectives and methods used for transfer pricing and custom valuation can vary significantly. So transfer pricing focuses on income tax compliance. It ensures that companies charge at arm's length prices on goods and services transacted between related entities, so that profits are appropriately allocated across jurisdictions, and we avoid what's known as base erosion and profit shifting BEPS, where profits are shifted to low tax jurisdictions. Now, with respect to custom valuation, customs valuation, on the other hand, is all about ensuring proper calculation of import duties and taxes. Customs authorities are concerned with determining the correct value of imported goods to prevent undervaluation, which could result in lower custom duties and lost government revenue. So you can see that both of them focus on different things. While transfer pricing focuses on income tax compliance, custom valuation, on the other hand, is all about ensuring proper calculation of import duties and taxes. Now, understanding these different objectives is critical for businesses that want to manage their tax obligations and trade compliance efficiently. So let us explore these objectives in detail. So we're going to break each of the objectives down. Now let's start with transfer pricing. The objectives. Now, transfer pricing ensures that intercompany transactions between related entities comply with the arm's length principle. The idea here is to price goods and services as if they were sold to an independent third party. This prevents companies from artificially shifting profits to jurisdictions with lower tax rates, hence avoiding base erosion and profit shifting BEPS. So essentially, transfer pricing focuses on ensuring that multinational enterprises allocate profits correctly across the countries in which they operate. We've been discussing this from Module 1 to Module 13. Now we're on Module 14. So now let's talk about the objective of custom valuation. On the customs side, the objective is to calculate the correct value of imported goods for customs duties and tax purposes. Customs valuation seeks to ensure that the declared value of goods reflects the true transaction value, so that the correct amount of duties and taxes can be collected by the government. Customs authorities focus on preventing undervaluation, where companies might declare a lower value for imported goods in order to pay less in custom duties. Now, the challenge is that these two objectives can sometimes conflict, creating a compliance burden for businesses. For instance, a company might declare a higher value for income tax purposes to comply with transfer pricing rules, but a lower value for custom duties, which can lead to discrepancies. Now, let's look at the key differences between transfer pricing and customs valuation. So let's highlight some key differences between transfer pricing and custom valuation, and that can between custom sorry let me take that again. So let us highlight some key differences between transfer pricing and custom valuation that can create these challenges. So there are three main areas where these differences might arise. One is basis of valuation. For transfer pricing, we use arm's length principle, which compares related party transactions to similar transactions between independent unrelated parties. Now, for customs valuation, we often rely on the transaction value method, which looks like the price actually paid for or payable for the goods at the point of importation. Let me take that again. So for custom valuation, we often rely on the transaction value method, which looks at the price actually paid or payable for the goods at the point of importation. So this price may include additional costs such as transportation and insurance that could not necessarily be factored into a transfer pricing analysis. The second one is adjustments. Transfer pricing adjustments focus on aligning profits with economic substance. This involves making adjustments for the functions performed, risk assumed, and assets used by each related party. For example, a subsidiary that bears significant market risk might warrant a higher return compared to one that performs routine functions. For customs valuation adjustment, on the other hand, they are more straightforward and typically involving adding costs like transportation, insurance, and handling charges up to the point of importation to the value of the goods for duty purposes. Documentation now. Transfer pricing documentation is highly detailed and often involves functional analysis, benchmarking studies, and reports that explain why a particular price was considered arm's length principle or should consider arm's length principle or was considered arm's length. Now, with respect to custom documentation, these tend to focus more on trade documents such as invoices, shipping documents, and customs declarations. Now, custom authorities may also ask for contracts and payment records to verify the value of imported goods. Now, let us look at the challenges. Given the differences we just discussed, it is clear that managing both transfer pricing and custom valuation can be complex, and businesses need to address several key challenges. So, one of the major challenges is consistency. One major challenge is ensuring that your transfer pricing policies are consistent with your custom valuation practices. This is very important. A lack of consistency could lead to audits, penalties, or customs clearance delays. For example, if the price you declare for income tax purpose is significantly different from the customs value, this can raise red flags. So you need to be consistent when doing your transfer pricing analysis and your customs valuation. Now, double reporting. Another challenge is the need to meet the documentation requirement for both transfer pricing and customs valuation. While both processes aim to value intercompany transactions, they require different sets of documentation. Businesses need to streamline their processes to avoid duplicative efforts. Now, with respect to reconciliation, periodic transfer pricing adjustments may not always align with the customs value declared at the time of importation. at the time of importation, it's essential to have it is essential to have a process in place to reconcile transfer pricing adjustments with customs declarations, ensuring that any changes in value are properly reflected in customs duty payments. So this is a complex but necessary process to maintain compliance. So with respect to reconciliation, let me just take that again. Periodic transfer pricing adjustments may not always align with the customs value declared at the time of importation. It's essential to have a process in place to reconcile transfer pricing adjustments with customs declaration, ensuring that any changes in value are properly reflected in customs duty payments. This is a complex but necessary process to maintain compliance. So let's look at the compliance requirements. Now that we have covered the interaction and challenges, let's move to the compliance requirements for customs valuation. Customs valuation compliance involves adhering to the rules and regulations set by customs authorities to determine the correct value of imported goods. Why is this important? It is important because if the value of goods is either underdeclared or overdeclared, it can lead to disputes with customs authorities, penalties, or delayed shipments. Now, customs authorities around the world generally use 6 key methods to determine the value of imported goods, which we will go through one after the other. Now, let's start. We'll be looking at transaction value method. The transaction value method is the most commonly used method. It is based on the price actually paid for or payable for the imported goods. Essentially, the invoice price becomes the starting point, assuming that the transaction between the buyer and the seller is at arm's length. The second method is transaction value of identical goods. When the transaction value method isn't applicable, customs authorities may turn to transaction value of identical goods sold for export to the same country. These goods must be identical in all material respects, such as quantity, brand, and reputation. The third one is transaction value of similar goods. If identical goods are unavailable, custom authorities use the transaction value of similar goods. This method allows for adjustments to account for differences in characteristics such as size, material, or performance. Another method is the deductive value method. In cases where no transaction value is available, custom authorities may use the deductive value method, which starts with the resale price of the goods in the importer's country and deduct costs such as profit margins and overhead. Computed value method. This method calculates the value based on the cost of production, including materials, labor, and overheads, plus a reasonable profit. It's typically used for goods that are produced internally within a corporate group and imported for distribution. The fallback method is the last resort when none of the above methods can be used. It employs reasonable means consistent with the principles of the other valuation methods, ensuring that the custom value is determined as fairly as possible. We'll look at the documentation requirement now. So for customs valuation, accurate documentation is essential to avoid undervaluation or overvaluation of goods. The required documentation includes invoices, detailed invoices that show the price paid or payable for the goods. These invoices must match the transaction value declared to customs. So second, we have contracts, sales contracts or agreements between the buyer and seller. These can clarify transaction terms and provide details that may not appear on the invoice, such as discounts, rebates, or commission. Shipping documents. Documents like bill of lading, airway bills, and other transportation documents which provide evidence of shipment and freight costs incurred. Payment record too. Your proof of payment, such as bank statement or letter of credit, can help custom authorities verify the transaction value and ensure that it reflects the true price paid for the goods. So let us look at case study now. Case study on transfer pricing. Let's look at case study 1. Now that we have covered the theory, let's look at the real world examples where businesses faced challenges in managing the interaction between transfer pricing and custom valuation and how they overcame them. These case studies will give you a better idea of how business can practically navigate the concept, the complex landscape. So let's look at this particular scenario. ABC Electronics Limited, a multinational electronics manufacturer, imports components from a subsidiary in China and applies periodic transfer pricing adjustment based on profitability targets. These adjustments impact the customs valuation of the imported components. Now, the implementation of this, we'll look at the transfer pricing policy. ABC Electronics uses the comparable uncontrolled price method to determine the transfer prices of these components. Whereas under the custom valuation method, the company uses the transaction value method, which is based on the invoice price declared at the point of importation. Now, let's look at the challenges that they may face after this implementation, after using the comparable uncontrolled price method and the transaction value method with respect to custom valuation method. Now, challenges. ABC Electronics faces the challenge of ensuring that periodic transfer pricing adjustments are accurately reflected in their custom value declarations to avoid discrepancies. So, having noted these challenges, let's look at what the solution would be. So, ABC establishes a reconciliation process to align transfer pricing adjustments with customs declarations. The company also maintains detailed records and communicates regularly with customs authorities. And by doing this, ABC achieves compliance with both transfer pricing and custom valuation regulations and ensure transparency and consistency in reporting. So let's look at another case study. Now, our second case study examines the DEF Pharma Incorporated, a global pharmaceutical company that imports raw materials from its related party in India. The company makes quarterly transfer pricing adjustments based on market conditions, which impact the customs value and the duties payable. Now, transfer pricing policy that they adopted, the method that was used, they used the transactional net margin method to determine the arm's length price for raw materials. Under the custom valuation method, the company uses the transaction value method for custom purposes based on the invoice price. The challenge between these two now is that ensuring that quarterly adjustments to transfer pricing do not lead to inconsistencies in customs declarations and that the correct amount of customs paid or the correct amount of custom duty is paid. So the particular challenge here is that ensuring that the quarterly adjustment to transfer pricing do not lead to inconsistencies in customs declarations and that the correct amount of custom duties is paid. The solution here is that DEF Pharma communicates and engage regularly with custom authorities to explain the nature of these adjustments and conduct periodic reviews of custom declarations to ensure accuracy. So through this proactive approach, DEF Pharma ensures compliance with both transfer pricing and custom valuation regulations while also avoiding penalties or back duty assessments. So we've looked at the implementation, we've looked at the challenges, And we've also looked at the solution, which is a proactive approach where DEF Pharma Incorporated ensures compliance with both transfer pricing and custom valuation while also avoiding penalties. Um, so let's look at and with this particular proactive approach, they are able to ensure compliance with both transfer pricing and custom valuation regulation while also avoiding penalties. So let's look at another case study. So case study 3. So in this final case study now, we'll look at GHI Automotive Limited, an automotive parts manufacturer that import parts from related entities in different countries. So GHI faces challenges in harmonizing its transfer pricing policies with customs valuation requirements. The company applies the resale price method to determine the transfer prices of the imported parts. But with respect to custom valuation method, the company uses the transaction value method based on the invoice price. Now, the main challenge for GHI is aligning transfer pricing adjustment with customs declaration to ensure consistency while also managing the documentation requirement for both transfer pricing and customs valuation. So GHI adopts an integrated approach coordinating between its tax, finance, and logistics teams to harmonize its transfer pricing policies with customs valuation requirements. So the company also conducts training sessions to ensure that relevant teams are aware of the interaction between the two. Through this effort, GHI Automotive achieves consistency in transfer pricing and customs valuation declaration and improves the efficiency of its compliance efforts. So we've seen different type of case studies, and the implementation that they've tried to do, how the harmonization effort, the custom valuation method, the transfer pricing policies that are adopted by the three different case studies, the challenges, and how they've been able to solve the challenge, maybe either by integrated approach, training and awareness of staff, or even ensuring that things are done properly. So, and the outcome has also been that they achieve consistency in transfer pricing and custom declaration, and this actually improved the efficiency of its compliance efforts. So, in conclusion, the interaction between transfer pricing and custom valuation requires careful management to avoid discrepancies and penalties. While both concepts deal with the valuation of intercompany transactions, their objectives and methodology differs. So by understanding these differences and implementing strategies to harmonize transfer pricing policies with customs valuation requirements, businesses can achieve compliance and optimize their tax and customs duty obligations. As we have seen in the case studies, adopting a proactive, integrated approach, whether through reconciliation processes, proactive communication, or consistent documentation, this can help businesses avoid significant compliance risk and ensure they meet both income tax and customs obligations. Thank you for your attention.